I think the risk-reward proposition for Bitcoin in the year 2024 is better than any other time in the history of the asset. Why can't it subsume all store of value property, which gets you to 200, 300, 400 trillion? This is why we want to study history. If you study history, you're going to find that the currency collapsed thousands of times. In fact, on average, it collapses everywhere. I think the Bitcoin gold rush era started January 2024, and I think it runs until around November 2034. This is the gold rush, because this is the period where there's still a lot of FUD, there's still a lot of uncertainty, people still aren't sure, they don't understand digital energy, they don't understand digital capital, they don't understand digital property. So the critics are misinformed, and the mainstream investors, they have all the money. There's $900 trillion of wealth out there. There's only 1 trillion in Bitcoin. So 99.9% of the money, of the wealth, is not invested.
This will be one of the most important videos you ever watch. Michael Saylor is perhaps the most well-known figure in the Bitcoin space. He is the founder and executive chairman of MicroStrategy. He is the man that completely spearheaded the wave of institutional adoption of Bitcoin. As of recently, MicroStrategy holds 190,000 Bitcoin worth $10 billion. However, I want to give you guys some context to this interview. 2.5 years ago, I was living literally paycheck to paycheck in a pretty bad apartment in a suburb just outside of Sydney. I had just begun making YouTube videos, and I decided to message Michael Saylor out of the blue. What did I have to lose? To my complete surprise, Saylor accepted the message, agreed to come on the channel for an interview, and after the interview, he stayed on and chatted with me for about an hour. Since that first interview, I followed Saylor's advice and wisdom, and it has completely changed my life. I'm now financially secure, I get to permanently travel the world with my best friend, and it's all because I listened to and followed the advice of Saylor from that first interview. Now, I want the same for you. Michael Saylor is a true trailblazer, and he's undoubtedly going to go down in history as one of the best investors to ever do it. Pay attention to what he has to say, implement his advice, and it will undoubtedly change your life. Also guys, if you want to level up as a crypto investor in 2024, make sure to subscribe to the new channel and drop a like. It's completely free and it helps out immensely. But without further ado, let's jump in with Michael Saylor. So let's jump straight into it. And before we get to the standard questions, I did want to ask you something I thought was super interesting. At the beginning of this year, it went a little viral, an excerpt from the Washington Post back in 1996. I wanted to read you one quote and ask you firsthand if it was in fact true. So the quote is, "For fun, Saylor says he reads 2-inch thick tomes on the history of Western civilization after he gets home from work at midnight." Michael, when I read this, I thought it was incredible, and I wanted to ask you, is this true, and is it still true?
You know, I always loved history. So yeah, it's sort of true. At the time that was written, I think I used to read excerpts from the story of civilization to new employees on their first day. And so I read about that, and that stuck with people. Now, I would say what I do very often is I listen to the audio versions of books and audio histories. And one thing I've been doing is rereading / listening the story of civilization. So that's the history of Western civilization by Will and Ariel Durant. And it's 12 volumes, 1,000 pages each volume. It takes about 50 hours to get through each one. And it's our Oriental heritage and the life of Greece and Caesar and Christ, the history of Rome, and in the Middle Ages, the age of faith. Right now I'm listening to the age of Voltaire, and I think it's really, really constructive to do this for a couple reasons. First of all, now you can, when I'm on a treadmill or walking down the street or in a car, I'm listening. So I feel like I accomplish more with my time than if I listen to the same song on repeat 98 times, even though I enjoy the song, but it's like 98 times the same song. But the second thing is when you study the history of the world, whether it's the story of Western civilization or Murray Rothbard wrote some really detailed books on the economic circumstances in the United States before Revolutionary War, called Conceived in Liberty. Or he wrote an Austrian economist view on the history of economic thought. And so the history of economic thought for 1,000 of years. And when you listen to those things at the age of maturity, you understand better and differently than when you, first of all, I didn't read it, in my teens or 20s. And now I do read certain things. But the second thing is if you've lived long enough, then when you read the stories again, you understand what happened, and it makes a lot more sense. So, and it's very relevant to Bitcoin, because what you see is you see the tension between chaos and order, and between authority, those wishing to impose authority, and then those wishing to promulgate freedom. And also, it helps you to overcome a lot of tropes, a lot of cliches. For example, people have been creating money or currencies for thousands and thousands of years. And in just about every single one of these stories, it always starts with a new ruler, a virtuous society, a new currency. They keep it strong. They expand. Everybody trades in the currency. Then they expand some further. Then they have to fight a war. Then they print more money to fight the war. Then they debase the currency. Pretty soon, the currency isn't worth anything. People don't want to trade with them because they debased the currency. They inflated it away. And then at some point, the soldiers realize that the money they're being paid in is worthless, or the soldiers don't get paid. And when the soldiers don't get paid, they all mutiny or they desert. And then invariably what happens then is someone outside of those borders wins the battle. And of course, that civilization blames their decline on the barbarians. Like, it wasn't our fault. It was bad guys who speak a different language or have a different religion. They actually attacked us unprovoked. And the story is always bad people caused the collapse of our civilization. But the real story generally is the civilization got fat, dumb, and happy, and then they got arrogant, and then they started counterfeiting money, and then they forgot that you can't pay your own soldiers with counterfeit money. And somewhere between the people starving to death or all the soldiers deserting, they found that they weren't able to continue with the wars they were fighting. And then they lose the war. And then the next society rises, and then they do it all over again. And it happens. It's not a dozen times. It's not 100 times. If you read this, it's thousands and thousands of times you see the rise and the decline and the fall and the reemergence. And there are always these common principles. And the principles have to do with power and energy, right? The societies that don't know how to, if you don't understand firepower, like the Japanese, they didn't really want to embrace guns, so they just passed a law, no guns. And then the Westerners showed up with guns. The same thing happened in China for a while, where they wanted to close their borders, and so they were against modern techniques. And then the Westerners show up with firepower, and then the borders get open, and then the political power structure collapses. And then at some point, someone comes up with a better cannon, and the people in denial lose the next battle, and then somebody comes up with a better ship. And then the people in denial have less sea power, and so they get choked to death. And then someone comes up with a tank, and then there's airplanes, and it goes on like that. It's always about harnessing power, harnessing and channeling energy. And you've got the physical energy, and that's how people win the wars. And then you have the economic energy. And all the really good societies, they manage to create trading networks on a strong currency that people trust. And then eventually the grandson of the person that set it up gets a bit cheaper. And then the great grandkids get a bit cheaper. They start fighting amongst each other. Then they debase the currency. Then their armies desert them, and their trading partners don't want to trade with them. And all of the commercial energy bypasses them. And then they blame it on the barbarians. And it starts anew. So that's all in Will Durant. If you read it, and what you realize, there's just nothing new under the sun. Everything's been played out. And history is almost the story of a bunch of arrogant alpha males that are a bit ignorant, that think that this time it's different, and they were put on Earth to fix things. And they go, Alexander the Great goes gallivanting off, in his late teenage years. And of course, we call him the Great, but the joke is, after he basically, conquered 200 countries and lost all of his army, he died by age 33, and everything collapses within months after he's dead. So it's like you can do this stuff for a year, 2 years, 10 years, and then everything collapses under its own weight, and it goes on and on and on like that. So I really like listening to that or reading those histories. I think you can learn a lot from them. And the most useful thing you can learn is this is not the first time this has been done. In fact, it's common throughout human history. Every single civilization, it failed because either it couldn't channel power, it was less powerful technically from an engineering point of view, right? Or because it couldn't channel capital, like economic power, and its monetary systems were completely defective, or they were inferior, right? The society that trades glass beads gets stomped on by the society that trades metal coins, and the ones that trade gold coins stomp on the ones that trade copper coins, and then even then, you believe that gold is money. The Spaniards go off, conquer the New World, they bring back all the gold. It doesn't solve the problem because they inflate the gold supply by a factor of 5. So they created hyperinflation. Their own economy collapsed, and the Spanish Empire collapsed because they didn't understand the implications of inflating the money supply. And they figured that out the hard way 1,700 years after the Romans figured it out, and they figured it out 500 years after the Greeks figured it out. And it happened in Egypt, and it happened in Assyria, and it happened in China, and it's happened as many times as we can write it down, and it's probably happened 100,000 times that we didn't write down. And so, yeah, I encourage people to read history, especially good political history, good economic history, and 1500. In 1500, they were using paintings as a store of value in Italy, right? That's an interesting thing that comes out. You'll find all of these principles just keep popping up. How do you find scarce, desirable assets to store your value in a portable fashion? And if you read it, then you'll say, "Wow, Bitcoin would have solved that problem." So, yeah, I think it's great, and I encourage people to read Durant and to read Rothbard and to read pretty much any history written by a reputable source, and do it now that you're an adult, because you understand things now that you didn't understand when you were in school, and it will resonate differently with you.
Amazing, amazing. What's that? I mean, there's that saying that if you don't study history, we're doomed to repeat it. And as you've said, it's the same story just playing out over and over and over again. And it looks like Bitcoin is a solution to that broken monetary system that is just a recurring theme throughout the history of civilization. Now, I do want to jump into a more standard question. I wanted to get to the big catalyst that we've had at the beginning of this year, and it was, of course, the launch of the Bitcoin ETFs. And although it was a bit of a rocky start the first few days that they were trading, it now looks like that a monster has been awoken, and this huge amount of money is just pouring into Bitcoin from these ETFs every single day. BlackRock right now alone currently holds 115,000 Bitcoin worth $6 billion. I wanted to ask your thoughts on how the Bitcoin ETFs have gone over their first month of trading. Were you surprised with how popular they were? I mean, they've shattered pretty much every ETF record there was. Or did it go exactly how you thought? Did the demand surprise you at all?
I'm not surprised they're successful. I expected them to be very successful. I think there's 10 years of pent-up demand. They're the most eagerly anticipated development in Wall Street. This is like Bitcoin coming public. It's like the IPO of Bitcoin, except it's like 10 companies simultaneously taking Bitcoin public, because Bitcoin's a commodity. It's not a security. So the idea that BlackRock and Fidelity and Grayscale and Bitwise and ARK, they're all taking Bitcoin public at the same time is a big deal. The fact that I'm not surprised they're successful as ETFs, because Bitcoin's the apex ETF. The other ETFs are based on oil, like let's say commodity ones, oil, gold, platinum, silver, palladium, market baskets of commodities, natural gas. All of these things are defective as investment assets because physical commodities aren't scarce. Physical commodities can be manufactured in any amount with additional capital and know-how. So ultimately, the best of them is the gold ETF. But if a bunch of money flows into a commodity ETF, that just actually fuels capital into commodity producers. They just dump that commodity on the market. The price gets held down. So commodity ETFs were never that great an idea. On the other hand, comparing these Bitcoin ETFs to the S&P index, the biggest ETF and maybe the biggest development on Wall Street was the launch of the SPDR, SPY, in 1993, about 30 years ago. And the idea that you could create an ETF that represented a market basket of 500 stocks, that was big. And especially that was big because that came along at a point where people had lost faith in the currency as money, as a savings technology. And so they were trying to figure out what is money. And actually an entire generation of people picked the S&P index as money, right? How are you going to store your excess cash for a decade or longer? Not a checking account, not a savings account, not a bond, but the S&P. So the S&P became money, and that ETF became the monetary index. And that's why today, amongst, that's the most successful ETF. If you look at SPY and all the S&P index type ETFs, they have most of the capital in them. But the problem with those ETFs is that stocks also are not conservative. So if I increase the price of the stock by a factor of 10, you're getting more equity. Or if another way to say it is, if I take hundreds of billions of dollars of cash and I buy the ETF, like S&P ETF, the ETF has to buy all 500 stocks pro rata, which means they're going to have to go buy Tesla and Apple and Google and Meta at any price. They're price insensitive, even if they're overpaying. So when they buy it at any price, what they're doing is they're creating more equity because they're encouraging those companies to issue more stock. And then, of course, this is common sense. If the price of your stock doubles, the employees in the company with stock options, they sell the stock, right? They sell the stock option. When they sell the stock option, you put more stock on the market. So the price creates supply. There's a price supply elasticity there. And that's the same as you have with commodities. It's the same as you have with REITs, real estate investment trusts. And it's the same thing with bond funds. When you have capital flows into all those other asset classes, you create supply of that asset. They're not scarce. Bitcoin's unique because no amount of capital flowing into a Bitcoin ETF is going to create any more Bitcoin. What we've got is 900 Bitcoin a day. And around April 16th to April 18th of this year, we're going to go to 450 Bitcoin a day. This will be the halving, but it will be the single most consequential halving in the history of Bitcoin because you're talking about, it's the equivalent of someone coming in the market saying, I'm going to buy $8.5 billion of Bitcoin a year for the next 4 years, guaranteed. That's the demand impact, right? $8.5 billion, $23 million a day at the current price. Now, that's a huge amount, but more importantly, that's a huge demand supply shift in the year when the demand via the ETFs has jumped by a factor of 4 to 10 times the daily supply. So what you have is institutional capital entering, and then you have the supply getting cut in half. And, what happened with these ETFs? Well, here's what happened. The approval of the ETFs was a pretty concrete endorsement of Bitcoin as an asset class by the regulators. And anybody who's thinking about banning Bitcoin or not approving Bitcoin ETFs, they're now out of consensus. So it really flipped the global consensus from, well, maybe it's too good to be true, maybe it'll be banned, maybe it won't be banned. The approval of those ETFs meant that it doesn't matter who wins the 24 elections. It's taken the future of Bitcoin out of the hands of the president. It's taken it out of the hands of the next head of the SEC. It's taken it out of the hands of most regulators in the world. We pretty much opened Pandora's box or crossed the Rubicon. It's very concrete at this point. And it was uncertain, right, before. And so that's a very big piece of regulatory clarity. What happened next is it's created a positive dynamic where now I think you're seeing pressure to approve ETFs in other places in Asia. You'll probably see Hong Kong spot ETFs. You'll probably see them get approved in any country where people are on the fence. It also created a fee war. It used to be that you paid 2.5%, to hold your money in Grayscale. And all of a sudden now you're paying 1.5% at Grayscale, but you're paying 25 basis points at BlackRock, or you're paying 20 basis points and even 19 basis points. Not only did that bring down fees for institutional holders of Bitcoin in the US, it also put pressure on international fees. So you actually saw a rippling effect, and people with European or Canadian or other spot ETFs in the rest of the world that had 100 basis point fees or 150 basis point fees, they're having to bring down their fees because otherwise the capital will flow out of their instrument into the lower cost instruments. So, yeah, let me convert the math here. If you have an infinite duration asset and you're going to put money in it, then the difference between 2% fees and 25 basis point fee is losing 37% of your money. You understand? Like it's like I take a third of your money. Okay. So if you're a Bitcoin investor, having low fees means you invest $1 million and you get to keep the $1 million. Having high fees mean you invest $1 million and you lose 300,000 of it over the course of 20 years. So those low fees are, well, where is that going to manifest itself? It's going to drive the price of the asset up, right? First of all, because the people that own the asset aren't losing 1 or 2% of their money every year. But second, because there are a lot of people that they will either invest $1 million in it or nothing, right? So if I like it, I'll just invest $1 million. If I don't like it, I'll invest nothing. So you start to see money flowing from gold into Bitcoin, from real estate into Bitcoin, from the S&P index into Bitcoin. And so that's a big deal. So the launch of the ETFs, it's been very successful. This is the ideal type of asset to put into an ETF wrapper. It's definitely it's the global asset. It's the biggest brand. Everybody knows what it is. It's actually the best thermodynamically sound investment. It's got the best historic performance. And of course, it doesn't have the entire array of risk factors that a company has or that a bond has. It doesn't have credit risk. It doesn't have corporate execution risk, and it doesn't have currency devaluation risk. And it doesn't have the physical risks of real estate. It's not going to ever get hit by a bolt of lightning. There's not going to be a tornado. It doesn't have maintenance decay. It doesn't have property tax risk. It doesn't have the political risk, right? Ask yourself the question, you got $1 billion and you got to buy some real estate in Africa. Where? And where do you want to invest $1 billion in a building? What country? What city? Where? Or you can buy Bitcoin. And of course, so you can see this is a higher quality thing. What was Bitcoin's number one liability coming into 2024? It wasn't the risk. It wasn't the thermodynamic risk factors. It wasn't the technical capabilities. The number one risk factor of Bitcoin coming into 2024 was a government would ban it. But see what just happened in January? The opposite, right? So most of the FUD around Bitcoin is, oh yeah, it's too good to be true, and because it's too good to be true, the government's going to hate that you bought it, and they're going to take it away from you. And with the approval of these ETFs, it was the government of the most powerful country in the world, the United States, which is actually the leader of financial regulation. I mean, whatever the US does will influence Singapore, Australia, New Zealand, all of the EU, even Hong Kong, even China for that matter, and all of South America and all the African regulators. So everyone's looking to what happens in the United States. This was a very powerful signal. So that was a bullish development. There was a little bit of weakness following, and I think that's fairly well understood as a couple of factors. First of all, a lot of capital rebalancing. There was capital sitting in the futures, Bto and other Bitcoin futures, because institutional investors don't have crypto accounts. They can't trade with most of the crypto exchanges, so they had to buy the futures. And the cost of rolling a Bitcoin position in the futures is like 10%. Imagine you have $1 million and someone charges you $100,000 a year just to have the trade on, right? I mean, so you could see anybody with that position, they roll out of the futures and they're rolling into the spot. So there's a lot of that. There were some people rebalancing. They had positions in Bitcoin companies and the miners and MicroStrategy, et cetera. And they're rolling out of those trades or rebalancing or arbitraging. There was a lot of people trapped in Grayscale and they couldn't get out. And then this unlock allowed some of them to redeem at par. And so there are some people that had 5 years of pent-up demand to redeem. And so we worked through that. And then you have the arbitraging between the high fee Grayscale and the lower fee other ETFs. And then finally, you have a lot of Bitcoin tied up in bankruptcy estates, in FTX, in Genesis, maybe, BlockFi, Celsius, Voyager, Three Arrows, Genesis, FTX, Alameda. Well, all of those estates are controlled by lawyers. And the lawyers aren't they're not hedge fund managers. They're not even 10-year investors, right? The lawyers have legal and process constraints. And maybe what they want to do is just wind down the trust, pay out the trustees, declare, or the creditors declare a victory and move on, right? So I think there's a lot of selling pressure that came out of that because a lot of them were holding GBTC and they wanted to redeem the GBTC at par, right? And get liquid. And so I think these are the transients, but at the end of the day, they're just transient factors, right? If you're buying Bitcoin with a short time horizon for responsible investors, 4 years. So if you're buying Bitcoin with a 4-year time horizon, this shouldn't matter to you at all. And of course, the right time horizon is 40 years. It's like your useful investment life maybe, and I mean, the inspired one is 400 years, right? If you think out 400 years, you'll do brilliant things, right? If you think out 40 years, you'll probably make the right decision. If you think out, 10 to 20 years, you won't have anxiety. 4 years is the minimum. But, people that are trading with 4 weeks and 4 months, right? They're just going to make awful decisions. They're the ones that probably panic sold it when it traded to 39,000, or they panic sold it when it traded to 16,000 or 20,000 12 to 16 months ago, and they probably bought it for the wrong reason. But ultimately, what we've seen is Bitcoin came public. It's clear that you're going to be able to own this as property for the long term. It's clear that this is going to catalyze a bunch of very positive behavior by other regulators in the world. It's going to accelerate institutional adoption. It's going to embolden the political supporters of Bitcoin. It's going to create a marketing war between various Wall Street firms. We see that going on right now. And it's going to strengthen and empower all of the OG Bitcoin holders, because even right now, people talk about, what has BlackRock bought $6 billion of Bitcoin and all these new ETFs. What have they bought? Like 1% of the supply. Well, that means 99% of the supply and 99% of the beneficiaries so far are the non-ETF holders. right? I mean, there's 100x as much. But if Bitcoin's up $10,000 a coin since this happened, well, that benefit accrued 99%, right? That's a $200 billion improvement in the market cap of Bitcoin. And of the 200 billion, 99% of the 200 billion accrued to people that don't even own the ETF, right? So it's accelerating, institutional adoption, and it's just accelerating Bitcoin adoption and empowering everybody else in the ecosystem to do all the things that they want to do.
Hey guys, I hope you're enjoying the interview so far. I just wanted to let you know, if you want to stay most up to date on the crypto and Bitcoin world, make sure to subscribe to our daily 5-minute crypto newsletter, The Crypto Nutshell. It's a daily email that gives you the top expert predictions, any breaking news, and top on-chain analysis all in a nutshell. We write it up every single day and send it to you for completely free. All you have to do is click the first link in the description, enter your email, and you'll get our email into your inbox every morning completely free. It'll make you a better crypto investor in 2024 and will make sure you stay on top of all the news in the space. But for now, back to the interview. Now, one thing I did want to ask you, I want to take you back to 2011, because many people in the space, especially newer people, they know you because of Bitcoin. But something I think that more people should know, especially people that are newer investors, they should know that this isn't your first rodeo. Back in 2011, you made a huge bet on Amazon, Apple, Facebook, and Google, and you wrote The Mobile Wave on why mobile technology will completely transform the world. You had huge conviction and you made a massive bet, and it turned out to be extremely successful. Now, the same thing's playing out. You have huge conviction on Bitcoin and you've made an enormous bet on it. I wanted to ask you the comparison between that first bet on the mobile wave on Amazon, Apple, Facebook, and Google, and how it compares to your Bitcoin bet. Do you have more conviction in Bitcoin? Do you think it's more transformative a technology than the mobile wave? And back in 2011, if you compare it to Bitcoin today, was mobile tech as misunderstood by investors than Bitcoin is now?
Yeah, I think it's a good analogy. I think if you roll the clock back to that period, we were looking at the digital transformation of a bunch of things in society. I mean, Apple was the digital transformation of devices and communications, and Facebook was the digital transformation of relationships. The idea you could literally monetize someone's relationship with their friends, right? And with Apple, your tape recorder, dematerialized into the phone, and your camera dematerialized in your phone, and then all your photos dematerialized in the photo album, and then your CD collection dematerialized. All these things, all your files dematerialized. So I always thought of technology like acid. It's just eating away and dematerializing things. Google just dematerialized every library in the world. And YouTube, dematerialized most video, but also you're looking at the dematerialization of education and entertainment, right? Education, entertainment, information, very profound things. So what are the consequences of that? Well, the idea that you could create one generic device, the iPhone, that 1 billion people would want, and that you could update and improve over the weekend with a software push. That was a big idea, right? That's a massive crystallization in the economy, whereby what if I told you I could replace 27 billion different devices manufactured by 1,000 different companies that come in 10,000 different form factors that are all analog, that are fixed, that can't be updated. And what if I said, we're going to replace all of those companies and all those devices and all that functionality with a single device running one operating system, the iOS, controlled by one company? Well, that would make that company the most valuable company in the world. And that would make that company the most valuable company in the world because that company could create the most value. Because on the weekend, they could give everybody 40 million songs, right? Everybody has, I'm giving everybody a 100,000 album library, and they can listen to any song anytime for the cost of electricity. And I don't have to manufacture 10 billion records or 10 billion CDs. And I don't have to 100,000 music stores, right? Like it used to be there were stores and they put CDs in them and trucks rolled, right? We had factories to make them and we had trucks to deliver them and we had 100,000 people to sort them and stack them and we had stores and we paid for electricity and people went to the store, Tower Records, and they picked it up. Well, the crystallization in physics, it's where you're collapsing to a low energy state. You know, you're going from water vapor or steam to water to ice. And at each step, energy gets given off. Right. And it's a basic thermodynamic idea, energy, heat. But, you know, in an economy, energy is money, right? Energy is profit. So when we collapsed, when we stopped manufacturing film and cameras and recorders, you know, and phonograph records and CVDs and DVDs and whatever you manufacture, when we stopped that, we reclaimed a huge amount of energy and that converted to money. And that accrued to the people that most of it accrued to the people that use the Apple product. That's why they became the most famous brand, right? I mean, everybody knows it's kind of cool to have 500,000 photos on your iPhone, right? It's like, and they're all there. So it accrued to them, but a small portion of it accrued to Apple, and that went to their shareholders, and that made them the most valuable company in the world. So in 2010, 2011, I looked at it and I said, well, eventually everybody's going to want this. Eventually everybody's going to have a computer in their pocket. And it's pretty clear it's kind of a winner take all thing. Apple ended up generating all the profit in the mobile phone industry, and everybody else lost money to compete with them. So it wasn't like they had 20% market share and got 20% of the profit. It was like they had the best product. They had 150% of the profit. 150% of the profit, 25% of the market. Everybody else lost money to compete in the space. And, you know, where did they go? Remember what happened to BlackBerry, what happened to Nokia, et cetera. Eventually, they all just went away. Motorola, yeah, if you recall. So why was I enthusiastic? Well, what I say is the way you make money is when you see a digital trend, everybody needs it. Nobody can stop it, but nearly everybody disagrees with you. Right? It's like if the majority of people disagree with you, they don't understand it, but nobody can stop it, but everybody needs it. That describes Amazon. Right? If you go back and read investment research on Amazon, everybody hated it. You know what they said? They said, oh, this is an awful retail company. They don't make any money. Well, they kept not making any money while they sucked the entire market up. And now there's Amazon, Walmart, and everybody else is bankrupt. Right? 20,000 retail companies fail. You know, one or two, Amazon, you know, Walmart, Target kind of are there. And then Amazon runs by everybody. It's because everybody, you know, who doesn't want to have everything they want delivered to their door in 1 hour for free? Who doesn't want that? Just like with Google, I want to go and I ask a question, I want the answer instantly, quick, and I want every book and every piece of information that the human race has at my fingertips instantly. Well, who doesn't want that? Everybody wants that. How about YouTube? Okay, well, like it's everything you want to know for free instantly, everywhere in the world. Okay, so everybody's eventually going to need it. Billions, you know, there's YouTube videos. They've got like 9 billion views, you know, on the video, right? So everybody wants it. Nobody can stop it. But then again, everybody thought it was a stupid idea, right? They didn't really get it. And the same was true with Apple. It's like people just didn't get it. And I'm like, well, a device that basically does everything you want it to do in your pocket that's, you know, 1 million times more powerful than the computer in the space shuttle. And everybody said, well, it's too expensive. Remember these things too? You know, you could buy Nokia phones for like $30. And the iPhone came out and it was $500. And the people made fun of it. It's 10 times as expensive. Well, what happened next? Well, Apple raised the price to $750. And the other phones were $20. And then Apple now sells iPhones for $1,500. So Apple keeps raising the price of the iPhone, and all these other cheap phones went to zero because at the end of the day, the point was it's what people want, right? It's just better. They don't want, people used to think, oh, they just want the cheap thing, just like they'd make fun of Amazon for this or that. But no, they don't. So those companies, they represent the digital transformation of retail, of information, of relationships. They made fun of Facebook. But, it's like when 4 billion people or 3 billion people are on a network, it's just so incredibly powerful that you can't stop the thing. These companies are now more powerful than a lot of countries, a lot of national governments. But the key point I'd make is the time to buy them was when everybody laughed at you. Back in 2010 to 2012, most people would have laughed at you. With regard to Apple, they would laugh. They would say, well, it's too expensive and Nokia's got the market or Motorola this or something. Or they'll never, the telephone companies will control the business. Or they would say, well, the stock is too high, so you should sell the stock because here's a classic one. It was 5% of my portfolio. The stock doubled. Now it's 10% of my portfolio. But my investor mandate is I never want to have any stock more than 5% of my portfolio. So every time Apple doubles, the gigabrains sell half their position. And so then it doubles again, so they sell half again. So then it doubles again, so they sell half again. So then it doubles again, so they sell half again. So after 10 years, they've got a little bit of Apple stock, and they bought all of the computer companies that went bankrupt. And they did it in a risk-averse fashion. And, again, the key point is diversification is selling the winner to buy the loser. And it's this common Wall Street meme or cliche, and they probably teach you in business school, and a bunch of guys in suits, they will tell you that. But all those dudes in suits that practice diversification, they didn't get rich because they diversified. They got rich because they instilled fear, uncertainty, and anxiety in a bunch of other people who then gave them their money and agreed to pay 2% management fee and give them 20% of the upside. So if you think about classic Hollywood, classic Wall Street masters of the universe, they will manage your money. You're a retiree, you're a doctor, a dentist, you give them your money, you give them your life savings. They charge you 2% a year, and then they take 20% of the upside, and then they tell you that it's too dangerous for you to own Apple. It's too dangerous to own Bitcoin. It's too dangerous to own Google. You can't do that. That's irresponsible. So here's what happens next. You give them $1 million at 2 and 20. And if you actually understand statistics or financial modeling, and then you just take that $1 million and invest it in the S&P index, and the S&P were to go up 10% a year, they get 4% a year and you get the other 6%. Which means that you just gave them 40% of your money. You had $1 million and you just gave them $400,000 and you got the other $600,000 back. And so if you ask yourself the question, who are the people telling you diversify? It's the people selling you the diversified funds, or they hold themselves out as these brilliant diversifiers. And what they're really doing is taking all your money, right? And on the other hand, name a billionaire that got rich by diversifying. Jeff Bezos didn't get rich by diversifying. Mark Zuckerberg didn't get rich by diversifying. Steve Ballmer didn't get rich by diversifying. Like Steve Jobs didn't get rich by diversifying. Pretty much, Elon Musk didn't get rich by diversifying, right? You could go on, and like, let's take even Warren Buffett. The most profitable trade Warren Buffett ever made?
Apple.
He bought Apple stock. And he made more money. They bought Apple stock 20 years late or whatever, and they made more money on Apple than they made on every other stock investment in the history of the company. And they made it in like 5 years. And it was concentrated position, like buy the dominant mobile company. right? And so I think that people are misled and they don't really they don't think about it much, right? If everything, by the way, if you're, it's no good to diversify if everything's correlated. For example, you could buy every possible company in Nigeria, but if they're all correlated to the Nigerian naira and the currency collapses, what good was diversification? So you really have to think about this. It's like I wouldn't say that there aren't successful people that happen to be diversified. I would just say that oftentimes this is a mantra that's brainlessly recited to give people an excuse to not think. And it's it's like, well, I got to diversify, so I own 37 different things. So that means you don't really understand any of the 37 things you own. And I would advocate you should spend 1,000 hours obsessing over each thing you own. And if you're the kind of person that can spend 5,000 hours and spend 1,000 hours on each of 5 things, then, good for you. Maybe you'll end up owning Apple, Amazon, Facebook, Google, right? And then maybe you'll say all 4 worked. And that's not so bad. But, I'm skeptical of a lot of the other, ideas that circulate, and they're just kind of mindlessly repeated over and over and over again. So coming back to the question you asked, right? What happened a decade ago was the digital transformation of all those things. It was the digital transformation of information. And it created trillions and trillions of dollars of wealth. And you could have actually made a lot of money if you jumped on that wave. What you have to do is pick the winner, right? There's 1,000 digital retail companies. There's one Amazon. You don't want the Amazon of Singapore. You don't want the Amazon of Nigeria. You want the Amazon, right? So you see, you have to pick that. There's one Apple, there's one Amazon, there's one Google, there's one Facebook. If you picked it, there's one Microsoft. If you pick it, you win. You pick the number 3, you probably lose. And so that was a big wave. But by 2020, that was still unstoppable. Like the Magnificent Seven has been an okay investment. Like if you bought all those stocks in 2020, you probably doubled the performance of the S&P index. The S&P index is up like 45%. If you picked the best 5 companies in the index, well, you double that performance. If you picked the rest had no return. Okay, so there's 493 or 490 companies that don't return anything. They're all losers. There's 5 to 10 companies that are the winners. And if you pick the winners, you do better than the index. If you pick the index, at least you brainlessly got some winners. But of course, Bitcoin outdid them by a factor of 3 or a factor of 2 to 3. So why was that? And the answer is by 2020, 98% of the people didn't disagree with you if you said Amazon was a good idea. See, by 2020, most people agreed with you that Amazon was a good idea. Most people thought, well, Google, Apple, Amazon, Facebook, they're monopolies, and Microsoft. Once everybody knows they're monopolies, once everybody knows they're unstoppable, once everybody knows that they need them, then you're not going to get a 10x or 100x performance anymore because all the capital has already moved into the market. Now, there's 2 problems with investing in those Magnificent Seven stocks today, in my opinion. And the one problem is everybody knows they're good and everybody knows they're essential. And so the market is adjusted. And that means that they're not undervalued. The second problem is the regulators and politicians will increasingly target them. They're targets because they're companies, whether it's targets to unionize or targets to fine or targets to regulate or targets to embargo or lever or censor, or, they're just, or tax, they're just targets. And that's challenging. And the third is they're companies. And this is related to the second problem, but it's a much deeper idea, which is a company is a capital structure, and the capital structure has a finite capacity for you to invest in. So, for example, if the stock of a company triples overnight, like Meta doubled the other day, if it doubles, then and it's valued based on cash flows, And then the cash flows have to double. If you double it again, the cash flows have to double again. If you increase the stock value by a factor of 10, expectations for cash generation have to increase by a factor of 10. That makes them even stronger cash derivatives in a period when you have inflationary money. So you're valued on cash flows, the money is losing its value, and so the debasement of the currency strikes at the heart of the value proposition of the company as a store of value. So that makes them increasingly risky and fragile. And that's exacerbated by the fact that there's massive political pressure in the conventional financial environment for them to return their capital to their shareholders. So when Meta stock doubles, they announce a $55 billion stock buyback, and then they announce a dividend. And that's Apple's playbook. Apple has been buying their stock back and dividending out their excess cash. Well, the problem is the company is valued, or the stock is valued almost exclusively on the P&L, or that is to say, the discounted value of the cash flows as expected into the next future, the next decade of cash flows. Now, if they took all their cash and they bought Bitcoin, let's think about like Meta, if they didn't give back the $55 billion. What if they actually bought $55 billion worth of Bitcoin? Now think about that for a second. Like, if they even bought $10 billion worth of Bitcoin and they announced that to the marketplace, Bitcoin would triple. They would have $30 billion of property. It would be going up 20 to 30% a year. So within a few years, they'd have $100 billion of property. If they actually executed the $50 billion buy, you would have $150 billion worth of property within 24 months. And that $150 billion would be accreting at 20 to 30% a year. But let's just say 20% a year. You're going to generate $30 billion of investment income per year, compounding. And so now you end up with a company where the balance sheet is worth hundreds of billions of dollars, not just the P&L. And so most of these companies, they don't have property, so they're valued on cash flows. And that means as a store of value this decade, that's increasingly risky, right? It's probably the best conventional idea anybody has, but having the best conventional idea is, it's like buying the best building in a war zone. It's like, okay, well, it's the best you could do, but you're still losing. Or it's like, it's finding the most comfortable cabin on the Titanic. Like, the ship is sinking. You have the presidential suite. Good for you. Now, I think that's hyperbolic in this case. I don't think the Magnificent Seven are sinking. But I think that when you're stuck in a certain frame of reference, there are just various degrees of mediocre outcome. There isn't winning. In order to win or get an excellent outcome, you have to think outside the box. And that means if you're in a war zone, you got to leave. If you're buying currencies that are denominated in a collapsing currency, whether it's a peso or a lira or a naira or whatever, you got to get out of that currency. If you're buying currency derivatives denominated in dollars, forward discounted, and the dollar is going to be inflated at 7 to 8% a year, well, that's your hurdle rate. You're going to have to grow your cash flows faster than 8% a year. Now, how many companies can grow their cash flows 15% a year for the next 20 years? Okay, now you might find some. Now the question is, can you protect them against politicians, foreign and domestic? Right? If your local politicians like you, will the foreign politicians like you, or vice versa? So those kind of investments, they're very fragile, and I think you got to be aware of them. And so I guess that's why I did what I did a decade ago. It paid off really well. But when 2020 came, the entire world changed. And the question is, what's the next thing? Yeah, Bitcoin's the next thing. But Bitcoin is like, I've said it before, it's kind of like Apple or Google in 2010. Misunderstood. Everybody needs them. Nobody can stop them. But it's a bit better because Bitcoin is an asset class. And so its target use case is store of value for the civilization, which means that there's no reason why it doesn't subsume gold, and gold's worth 10 trillion as a store of value? Why can't it subsume real estate at 100 trillion? Why can't it subsume all store of value property, which gets you to 2, 3, 400 trillion? And the more valuable it gets, the more useful it gets, right? The fundamental big idea, and it's very difficult to explain this to people, but if Bitcoin increases in value by a factor of 100 because people buy it as a store of value, it's 100 times more valuable. Whereas if Apple stock is 100 times higher priced, the cash flows in the next 20 years have to keep up, right? And people that criticize Bitcoin, they say, well, it's got no cash flows. Well, that's not the defect. That's the feature. It's not a liability. It's the fact that it's something that is not valued on cash flows means it's never going to miss its quarterly cash flow expectations, right? In fact, it's a reflection of the cash flows that have flowed into it. And so Bitcoin is just a much more powerful idea. It's the digital transformation of capital, right? It's not digital information, it's digital energy, right? Energy is matter, energy is capital, energy is property, right? And so Bitcoin is digital energy. Google and Apple and Amazon, they were all about digital transformation of information. And I think that was the 30 years. It was a 30-year trend. I just think we're kicking off another 30-year cycle. And Bitcoin is this big driver of this digital transformation of energy. I use the word energy because energy is conservative, right? It can neither be destroyed nor created. There's conservation of energy, just like capital, right? I send you $1 billion, you get the billion, I don't have the billion, right? Whereas when I send you my record collection, you've got the records, I've still got the records. You see? I send you my photographs, you've got the photos, I've got the photos. So information is non-conservative. Energy is conservative. Bitcoin represents the digital transformation of capital, right? Most people don't agree. Most people don't even understand, right? Right. The beauty of this is it's not that they understand and they disagree. It's like you say Bitcoin is digital energy, and even the people in the crypto space will disagree with me. They're like, what do you mean? No, it isn't. It can't be. Like, that's not what it is. They don't get it, right? And so that's a paradigm shift so profound that you can say it in front of someone, and unless you have 100 hours to show them 100 examples and can conduct a Socratic tutorial for them and answer their 100 questions and show them 3-dimensional visualizations and then make 100 connections. If you don't have that time, they just look at you, they blank, they disagree, they misunderstand, and so they don't buy. But that's exactly what you want. You want something which can't be stopped. The fact they don't agree and they don't understand doesn't mean it's stoppable any more than I start a fire in Chicago and it's burning. It's like, you might not understand there's a fire. You might not know fire. You might wish there isn't a fire, but the fire's coming, right? It's not stoppable, right? It's a chain reaction. And this is a chain reaction right now. That's what makes it, I think, such a compelling proposition.
Amazing. And yeah, I think the mobile wave bet that you made in 2011 should be known by more investors because there's so many parallels between it. And I think it's just amazing that it's not your first rodeo and you've done it all before. Now, something I wanted to relate back to, you mentioned Warren Buffett, and we were talking about diversification and how that's people don't get rich. We write to 50,000 people on our email list every day. And the most common question we always get is, am I too late to Bitcoin? And you mentioned when Warren Buffett, his best trade was buying Apple, and he was 20 years late to it. So big pushback we get is that the cost of living has gone up so much, wages and people's salaries haven't increased at the same pace. And at this point, it's impossible for some people to accumulate one whole Bitcoin, and even to get to 0.1 Bitcoin is a stretch at this point. What would be your response to people that think they're too late to Bitcoin, or that they're too late to the party? They see it at 50,000 and they think that the boat has left the port and they're too late.
I think the risk reward proposition for Bitcoin in the year 2024 is better. than any other time in the history of the asset because you have institutional adoption, you have regulatory clarity, you see capital coming into the space, and yet still you can do the survey yourself. Ask 100 of your friends if they're fully invested in Bitcoin and if they understand it. And if 95 say no, right, I would say do your own research. But Bitcoin's 15 years old. So let's look at other great investments. 15 years after Manhattan was founded, was it a good investment? We could start 200 years after Manhattan was founded. In 1776, roll the clock forward, 1791. Was it a good investment? And was real estate in Manhattan in 1791 a good investment? Was it a good investment in 1865 after the Civil War? Was it a good investment in 1970? Was it a good investment 15 years afterwards in, 1995? Was it a good investment in London 20 years ago? 2,000 years after the Romans showed up in London, was it a good investment to buy London property? Right? I mean, these are scarce, desirable properties, right? It's 15 years late is not late, right? The difference between the winners and the losers is the winners buy something valuable and the losers are afraid, right? The losers are afraid to buy the valuable thing because it's too expensive. New York real estate was the most expensive real estate in the United States 300 years late, right? It's always been the most expensive. Apple Computer was founded, I think, 1976, around then. 15 years after Apple Computer was founded, was it a good investment, right? Check the price of Apple stock in 1993 or 1996. I think in 1998, Michael Dell told the board they should shut it down, give the money back to the shareholders. But the truth is, at many, many points in time, it was a good investment. I think, as I'd said, the real key is to understand what is Bitcoin's use case. It's digital capital. Well, how big is that? $400 trillion? Right? How much capital is locked up in real estate, equity, currency, bonds, collectibles, trophy assets, precious metals in the year 2024? Right? There's probably half the value of most residential real estate is the monetary premium. It's the capital. So, how do you know this? I give you a little test. Go to Miami Beach, go up and down the beach, and then count the number of lights on in a condo building on the beach. Or go to Monaco and count the number of lights on. And what you'll find is that 80 to 90% of all of the condos don't have lights on at night. So people have huge amounts of capital tied up in these idle assets. And there's a lot of reasons for them, but one reason is because they feel like their money is safer there. So in the 20th century, people basically bought sports teams. I mean, ask yourself, what do rich people own when they get rich? They bought sports teams, they bought real estate, they bought companies, they bought land, they bought timber rights, they bought oil rights, they bought gold, they bought, bonds. They just bought stuff. Why? Because they knew if they left their money in the bank, it was going to dwindle away. Buy anything. They buy Picassos, they buy art, right? They buy stuff. So there was never a perfect digital capital. There was never a digital instrument where I could, if you were a rich Russian and you had a choice between buying a bunch of real estate in Moscow or buying Bitcoin, well, with ex post facto hindsight, looking back for the last 30 years, okay, now let's play that out and you're a rich Nigerian. Now you're a rich, Turk. Now you're rich in Lebanon, right? If you, and we don't have to be rich. You can, anybody with any amount of money anywhere in the world, right? You've got the last 100 years of history. You live in Germany in 1930. What do you want, a building or Bitcoin? You live in Argentina. What do you want? You want to own land? You want to own a building? You want a company? You want Bitcoin? The currency is going to collapse 5 times in 140 years. 5 times, right? Okay, so this is why we want to study history. If you study history, you're going to find that the currency collapsed thousands of times. In fact, on average, it collapses everywhere. Probably it collapses everywhere on average every 50 years in the history of the world. And that's maybe me being charitable. So is it too late? Well, can you actually take all of your property, put it in your pocket, and leave the country on 1 day notice if you need to? If not, then you're probably not too late, right? So if you go through that exercise, you can't take your building with you. You can't take your bars of gold with you. You can't take your stock shares with you. People for a while, they bought paintings thinking I'll roll them up, but, it might not be easy to, and the average person can't buy Picassos. They're not quite exactly at the price point. How do you buy $237 a Picasso a week, right? So Bitcoin represents digital property. What's the value of digital property? Hundreds of trillions of dollars. Is it overvalued? Not yet. It's $1 trillion right now. So when it's 100 times more valuable than it is right now, will it be overvalued? Not likely. It's probably still going to be appreciating faster than every other thing you can buy. Why? Because it's better than every other thing you can buy. Show me a hotel you can put in your pocket and teleport. Right? $1 billion of gold is like 3,000 pounds, right? How are you going to move that, right? Right? Give me a company that's going to last through the next 3 CEOs, right? Do you know who the third CEO will be after the one that runs the company now? And do you trust that person? Right? The S&P 500, haven't we established there's a 99% failure rate? These are the winners. There's a 99% failure rate to generate shareholder value amongst the 500 best companies in the world. Now, if there's a 99% failure rate amongst the 500 best companies in the world, then what's the failure rate amongst the 100 million companies in the world? And, what's the most successful nation-state currency in the history of the world? Well, if it's the dollar's lost 99.8% of its value in 100 years. Maybe 99.9% of its value. You could debate whether it's 99.8 or 99.9% of its value. Every other currency in every other country lost 100%. So if you're sitting around wondering, is Bitcoin overvalued? The question is overvalued versus what? Right? You're going to buy something, right? You're owning something in lieu of Bitcoin. What is that something which is better? Right? That's the real question. Because not selling is buying, but not buying is selling, right? And you've basically got a certain amount of economic energy. It's deployed somewhere, right? And the question is, what are you invested in that you think is better? And I think everybody's got to answer that question themselves. But, like if you owned a football team, like what's the odds that people are still going to watch football in 250 years? And what's the odds that you can put the football team in your pocket and leave the country? Not high, right? I mean, and what's the odds that, you get attacked by, what if there's some law that says that you're liable for the physical damage and the emotional harm to the football players? And, if someone gets hurt playing football, you have to pay $100 million settlement, right? That happens. Or even better would be, what happens if someone goes to a football game, watches it, and is traumatized by all the violence, and they form a class action lawsuit and they sue you? Mightn't that happen? Happens all the time. Right? Look at the history of opioids. Look at the history of cigarettes. Look at what's going on right now at congressional hearings around social media. At some point, you'll have trial attorneys suing tech companies because someone used a website and something bad happened to them, right? So there are a lot of risks no matter what you invest in. If you think you don't have risk, you're simply ignorant of the risk you're currently embracing. And I think that once someone understands fully all their range of risk, then your conclusion is, no, it's not too late to buy Bitcoin.
Amazing, amazing. And right at the beginning there, you said in 2024, you don't think Bitcoin has ever represented a better risk to reward ratio. Looking out in 2024? Like, it seems like we have this insane confluence of factors. ETFs launched at the beginning of the year. In April, we have the halving. Correct me if I'm wrong, we have the FASB accounting rules go into effect this year. Then we have the election in November, so it normally means more liquidity. What is your general outlook for 2024? Do you think this is just going to be a complete watershed year for Bitcoin because of this confluence of all these things coming together?
I think this is going to be a good year for Bitcoin. I think we started out the year with the ETF approval, and that was a big milestone. I think that the success of the ETFs is another milestone. I think that the halving in April will be a third positive milestone. I think those three things are going to drive momentum, and I think all the marketing wars between the Wall Street firms is going to be positive, and I think the assets being normalized throughout the mainstream investment community, and so I think it'll just keep generating momentum from here. I think it's also worthwhile, I think, to make one point. I think that we're living through the Bitcoin gold rush era. And I think the Bitcoin gold rush era started January 2024. And I think it runs until around November 2034. So it's about 10 years. And I'll tell you why. Because 93.5% or so of the Bitcoin was mined at the beginning of this period. But in November of 2034, 99% of all the Bitcoin that will ever be issued will have been issued. And so that halving is very symbolic. People talk about Bitcoin, issuance coming out over the next 100 years, all the way till 2140. But the truth of the matter is, the last 100 years, you're only getting 1%. So think, and actually, of that 1%, 90 basis points of it is coming in the 12 years that follow 2034, and then it's 10 basis points, 0.1%. But practically speaking, all of the block rewards are de minimis starting in 2034. It's 1% over 100 years may as well be nothing, because the daily volatility and the daily trading volume is going to render that to be somewhere between third order, fourth order, fifth order of magnitude. So that being the case, really, this 10 years is your best chance to get Bitcoin, right? This is the gold rush, because this is the period where there's still a lot of FUD. There's still a lot of uncertainty. People still aren't sure. They don't understand digital energy. They don't understand digital capital. They don't understand digital property. There's a lot of debate in the community. Is Bitcoin a currency, or is it a property? Or, there's massive debate. And a lot of people say, well, it's a currency, and since it's not legal tender, or because it doesn't move fast enough, or I can't buy coffee with it, it's not a good currency. So there's a lot of confusion in the crypto community. There's a lot of mainstream regulators, they think it's currency. So you see bankers say, oh, it's a currency, but it's not a good currency because I can't buy coffee with it. I can't buy things online with it, and it's too volatile. And they think that's a criticism. And so they criticize it. And then people that think that they know what they're talking about, they hear some famous person say, well, Bitcoin is not a good currency, and or the government will ban it, or it's not as good as the dollar or something. And so they get afraid. And they say, well, then I trust that guy, so I'm not going to buy it. So a lot of people are criticizing it for the wrong reason. A lot of people misunderstand it, and that creates lots of chaos, misinformation, stupid, misleading stories in mainstream media. It creates like bad takes on Twitter. It creates all sorts of confusion amongst Wall Street analysts. And so all of that fear, uncertainty, and doubt, and just basic confusion, and then misunderstanding, that causes a slow growth in demand, right? Like, demand is growing, but imagine how much faster it would be growing if everybody had spent 100 hours, right? Right? The people that criticize it, there's no way Warren Buffett spent 100 hours studying Bitcoin, right? There's no there's not likely that everyone that criticizes it spent 100 hours studying it. They haven't read the Bitcoin Standard. They probably haven't listened to 20, 30, 40 hours of podcasts, right? So the critics are misinformed, and the mainstream investors, they have all the money, right? There's $900 trillion of wealth out there. There's only 1 trillion in Bitcoin. So 99.9% of the money, of the wealth, is not invested, right, in the asset class. So a lot of people that don't understand what this is have a lot of money, and yet we've got a 10-year period when there's going to be an explosive increase in education, right? As Bitcoin's going to go up, and as the price goes up, more people are going to get asked, and they're going to reject. They're like, stop asking me. I hate talking about this. Like, we don't like it because it's like gold. It doesn't generate cash flows, or they don't understand. If you don't understand perfect money, right? What's wrong with gold? Gold has emissions. Gold is inflationary. That's why it doesn't work. If you don't understand that, then you don't understand why digital gold is better than gold. So you don't understand Bitcoin. You don't understand money. And then you haven't really thought very deeply about property theory or capital theory. So you definitely don't understand digital capital, which means you don't understand digital energy, which means that when someone asks you, you're going to buy it, your answer is, of course, I'm not going to buy it. I don't get it. But when I say to people, right, like, if everybody read all these books, if they listened to all your podcasts, if they listened to all my podcasts, if they thought about it for a few hundred hours, tomorrow they would wake up, they would all buy Bitcoin, and Bitcoin would be $5 million a coin. And then we'd be doing this podcast, and you would say, Mike, all the comments from all my followers are, is it too late? And I would say, well, it's too late for you to get insanely rich. You're not going to get 100x, right? If you buy Bitcoin at 50,000 when it's 5 million, you're going to be bragging to your kids that you got 100x your return, right? So it's going to be too late for that. But it's not too late to buy it, because it's still better to buy the thermodynamically sound digital asset, which doesn't have all of the liabilities of real estate, stocks, or bonds. It's still going to go up in value faster than the S&P index. It's still going to be a better after-tax return than owning sovereign debt. It's still going to be better than owning physical property subject to acts of God, force majeure, and all the other physical limitations. So it's still going to be the best investment. It's just not going to be the investment that got you the 100x return that you were going to brag about. And so there's no reason to worry, right? Or fret. You don't want people to figure this out, right? Like if they figure it out, you have 10 years during which you can work and you can buy Bitcoin while everybody else disagrees with you and doesn't understand it because they're intellectually lazy or they're a different generation, right? So that it's like me saying it's 1905 and in 15 years, everybody's going to have an automobile. And now you know. Okay, well, you have 15 years to get rich in the automobile business. Figure out, are you going to set up the dealership in New York City? Are you going to start a company? Are you going to be a salesperson? What are you going to do? You have 15 years. Figure it out. This is better than that. But this is a 10-15-year head start. I had this analogy. It's like you could be working at a McDonald's. You could be working for $10 an hour, right? But if you're sweeping the $10 an hour in an asset that goes up by a factor of 100, you're getting paid $1,000 an hour. Okay, so how long do you want to work at $1,000 an hour? Well, you want to work at $1,000 an hour as long as you possibly can, because once people figure it out, then you go back to your $10 an hour job, right? So we're in the gold rush period. People are, when they think about it, they're going to realize this is the period during which everybody in the world started to realize Bitcoin is digital capital, and there's a digital transformation of money, and that you want to hop on top of that. You want to exploit that, And there's 1,000 ways to do it. Maybe it's just work really hard at your job and buy Bitcoin. Maybe it's start a company. Maybe it's do something different. You decide, right? But I don't ever regret any stacking I did. I mean, we bought Bitcoin, below 10,000. We bought Bitcoin probably above 60,000. I mean, at the end of the day, we never know when the world wakes up, gets rational, and then it runs through the all-time high, and then we regret not having bought more. I would encourage anybody that thinks maybe I'm too late. I mean, I think I would say, well, maybe you just haven't studied this enough, right? You don't give me your money if you're not confident. Give me your time, and if you don't want to invest the time, maybe you don't care about money that much. It must not matter to you that much. If it matters to you, then you spend enough time to figure out whether I'm right or whether I'm wrong. And there's plenty of information out there for you to come to your own conclusion.
Amazing, amazing. And just finally, I want to be super mindful of your time. So I only have one question left. And I'm actually going to take it away from Bitcoin and crypto and take it a bit more broad. Michael, you're clearly an incredible, successful person. You've taken huge bets throughout your career and you have massive wins over and over. You've clearly learned a ton of lessons and you have a huge amount of insight. Let's say there was a young entrepreneur out there, say, just randomly, he was 26 years old. If you could give one piece of advice on what to focus on or what tips you would give if they wanted to have a degree of your success, what advice would you give?
I would say in every generation, you have to consider the transformational technologies that remake the world. Whether it's the internal combustion engine or whether it's a computer chip or whether it's the internet or whether it's the airplane or whether it's the piano, figure out, or the electric guitar, right? What's the transformational technology? I rather think right now it looks like the transformational technologies for the next 20 to 30 years are digital intelligence, that is AI, and then digital money or digital energy, which is Bitcoin, right? And the idea that, you can embed digital intelligence into a car, a plane, a drone, a robot, a website, a product, a service, an AI, that's a big idea. And certainly there are going to be massive fortunes made. And if you understand how to embed digital intelligence, right, there's going to be a demand for that. And with regard to digital energy, right, the idea you can embed digital energy into a product, a service, a website, a company, a country, an institution, right, is a big idea. So you ought to think about how you might take advantage of that. Now, there may be other things, right, in the domain of medicine or physics or the like. I'm not an expert on all. I mean, these are two obvious transformational technologies. I would say pick the thing that you love, the thing that you're most interested in, and then I would say focus, because the most common mistake I think people make is, well, there's two mistakes. One is they pick the last generation technology, right? It's the thing that made your father or your grandfather or your great-grandfather famous, successful, rich, powerful, right? Is probably not going to work for you. You're not going to fight the next war with the same weapons you fought World War II with. And they didn't fight with the same weapons they fought the Civil War with. And you're not going to get rich the same way John D. Rockefeller got rich. So don't try to do what's been done. It doesn't matter how hard you work. No amount of work, right, is going to allow you to overcome a technology disadvantage, right? Nobody cares how hard you work if you're working with a hammer, trying to hammer your way through a mountain. So that's the first thing you don't want to do. But the second thing is, oftentimes people, they find that technology and they have a modicum of success and they get going on that platform, and then they declare victory and they think they take that for granted. So then they go to find the next success. So they want to conquer the second thing and then the third thing and then the fourth thing and then the fifth thing. And what happens, it might be something as simple as you're successful on YouTube, and so then you decide you're going to do TikTok. But TikTok is different than YouTube. And so you know, you find yourself basically creating mediocre TikTok things, and then your YouTube content gets mediocre too. And then someone else, offers you a third thing, and you decide that's what you're going to do. And pretty soon you're doing three things and everything's mediocre. And gradually, your customer base, your fan base falls off, your support falls off because you diluted your focus. And I think here's the phrase I would leave you with, right? Nobody fails because they pursue bad ideas to the detriment of their good one. They fail because they pursue good ideas to the detriment of their great one. Right? So figure out the one thing that you can be great at, and then don't make the mistake of diluting your focus and your effectiveness because you're good. It's like, don't be Michael Jordan, the basketball great, and then go play baseball. You'd be a professional baseball player. 1 in a million people could be a professional baseball player. But you see, trading the 1 in a billion to be 1 in a million is a mistake. And he figured it out, right? Hopefully you figure it out. The tragedy is you have something which is going to work, and then you get distracted, right? And a lot of these people look at Apple computers, like Steve Jobs. It's like, at the point everybody's written you off, the difference is they don't quit. Like, they don't give up ever, ever, ever. They just keep going, laser-like focus. And it's easy to say, but how many people can keep laser eyes on Twitter for 4 years? That's the joke. How, if you went and counted the number of people that put laser eyes and then they took them off after 3 months or 3 weeks or 3 days or 3 years. And of course, the irony is, right, you can't even get a college degree in less than 4 years. You can't be a doctor without 10 years of work. But a lot of people, they just expect it to work in 10 weeks or 10 months. And I would say, my advice to anybody is find something that gives you a technology edge or lever, the ability to create something which impacts the most amount of capital or the most number of people. You want to have the maximum impact, whatever that is, the max leverage. And then once you figure that out, relentlessly refine your craft. 10,000 hours. And then by the way, 10,000 hours to become the great guitar player, the great piano player, or the great podcaster, or the great whatever it is. After you do that, then go do it. And then after you get recognized as being successful, don't go on to the next thing, right? Focus upon the thing, right? Keep doing the thing. Don't take your success for granted. Because I think we see all the time people, they take their success for granted, and then they go off to conquer the next objective, thinking that somehow it'll be just as easy and it's important for them to do it. And what happens is that second thing dilutes the first thing, and by the third thing, they've diluted everything, and by the fourth thing, they're just dropping all the balls, and everything comes crashing down. And there's somebody else in the world, they're going to put in the 10,000 hours, and they're not going to get distracted, and they're going to eat you, because it's a very Darwinian world, and it's very competitive. And if you're not insanely good at something, it's not clear that anybody's going to need you for anything.